So do you want to understand the Federal Reserve's internal rate and how it affects mortgage rates? Here's how we describe it. Assume that the Federal Reserve and Jerome Powell is Betty Crocker. What they do is make cookies, right? And their cookies, they decide how many they're going to make. And that amount of cookies that they make is going to decide on how many cookies that the bank can borrow from Betty Crocker, Jerome Powell, right, at a time. So during the pandemic, Jerome Powell and the Federal Reserve, Betty Crocker, if you will, decided that cookies, we want the banks and the cookie buyers to get a lot of these cookies to help stimulate the economy. So they created the internal reserve to be 0 cookies. So essentially they went banks, buyers, free cookies, everyone. So the banks have to make a profit. So they go, all right, perfect. We're getting cookies for free. We'll charge these cookies for 1 cookie to be able to get 2 cookies. So you got a lot of cookies. Now what happens is the Federal Reserve goes, inflation is happening. People are eating too many cookies. The economy is getting fat, inflation like that. So now they go, all right, we're going to have to start charging more cookies. So it's going to cost you 2 cookies to be able to get in. So now the banks understand this, all right, it's 2 cookies to get our cookies kind of thing, right? So we're going to charge 3 cookies for the people. Now, mortgage rates are 3 to 4, 5%. Understand the importance. So right now, the Federal Reserve is charging 3.3 for cookies, right? So the banks are going, hey, it's 6.5 cookies. That's your mortgage rate. There's not a direct correlation to how many cookies exactly the Federal Reserve charges versus what mortgage rates end up costing. The other really important thing to notice is this. So if Betty Crocker, Jerome Powell, Federal Reserve, goes to their annual meeting or one of their meetings and go, hey, we are planning to forecast to reduce our cookie rate by this amount throughout these time periods. The banks hear that and go, oh, cookies are going to get cheaper in the future. All right, we're going to reduce the amount of cookies right now, knowing that it's going to be cheaper. So cookies go down right away. So understand when the Federal Reserve, and this is also a really big point to get, if you remember back when the inflation just started to happen and the Federal Reserve started talking and everyone started listening and interest rates skyrocketed on mortgages. Back then, Federal Reserve was like, hey, we're going to increase the internal cookie rate up to this point throughout the next 3 years. So at that point, the banks went directly to go, cookies are 7. Even though internal cookies for the Federal Reserve were only at like 2 at that time and then steadily increased that. The banks went directly to it. So the banks are really predicated based off of what the Federal Reserve and Betty Crocker, Jerome Powell are going to say is what's going to happen with the cookie making of what they're doing. So understand that right now, they've said some pretty good things that, hey, cookies are going to get a little bit cheaper. Economy's doing well. Inflation's doing okay. Jobs report are looking a little bit better, right? Economy isn't getting overinflated and fat, right? We're going to be able to reduce this a little bit to be able to stimulate a little bit. Banks are going to initially right away reduce the amount of cookies on that. So we're starting to see those prices baked in. Oh, that is actually something you'll hear from a lender or from an economist of saying the prices are baked in already, right? So understand that when they go, hey, well, I'm going to wait for the Federal Reserve to reduce their internal cookie rate. Well, actually, the banks already knew this was going to happen. So they're already adjusting rates accordingly based off of what they think the future is going to bring, right? Understand it as well as when the Federal Reserve says that, if they get to the next meeting and go, oh, whoopsie, we forecasted incorrectly. The banks that day, that second, will all of a sudden go, boom, cookies back up to being really expensive. There is a cookie analogy of how the Federal Reserve, Jerome Powell, internal overnight interest rates affect housing market and mortgage rates. They're not directly correlated, correlate pretty well, but understand that based off what they say is what's going to happen with mortgage rates, and it'll happen quicker than what they actually do. Understanding what they say in their forecast for the future is going to affect mortgage rates now rather than actually when they end up doing it. So don't wait for them to actually drop all the cookies all the way down because the cookies are already cheaper. And always still be weary when they say, hey, cookies aren't going well, they'll get more expensive. Betty Crocker. Call me, I'll talk about this with you for hours. You want to talk about economics of real estate, the market going up and down, foreclosures, Federal Reserve, cookies.